Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for this segment, we had Ed Coughlin, head of trader services at Nasdaq, to discuss the extended traded close. Ed, it's great to see you as always. Welcome back to Trade Talks. And ETC sounds like it's something pretty exciting.
Yeah, we're real excited about it. It's been kind of well received by all types of firms, investor communities out there. One of the things in developing ETC is we recognize kind of the demands on liquidity around the close. We see the activity leading up to the close, post the close, and we were trying to come up with solutions to innovate around the close so that we could offer better tools for traders as they interact in the close.
So how does it work?
So if I look at ETC, the ETC basically takes the closing price, and we allow continuous market trading between 4 and 4:05, after the close, so that investors that may have missed the close have an additional opportunity or another bite at the apple, I often say, to try and trade there. And what happens is the closing price is established. Let's say the security closes at $20. We start accepting orders post the close to trade or to continue to trade at $20. So if firm A comes in and says, I want to buy 50,000 shares at $20, and it's 4 o'clock and 20 seconds, and firm B comes in and says, I want to sell 20,000 shares, immediately on the tape, we'll print 20,000 shares to the tape that trades at 20, and we'll tell the rest of the world that 20,000 shares traded at 20, and we still have 30,000 shares to buy. And it's certainly our hope that this helps traders in facilitating liquidity in those few minutes post 4 o'clock.
How do investors view this information, execute trades in extended traded close?
So what we've done here is we're leveraging the existing NOII data format. So firms are used to all of our auctions in which we send them imbalance information that gives them, obviously it's the symbol, the side, the shares, the price of the auction itself. And so what we've done is we've taken the same protocols that's used for the NOII order information, leverage those to make it seamless for customers to see the activity that's happening post the close, so that firms don't have to do a thing, but rather than just look and consume the data so that they can see it. And then as far as the order type itself, firms simply need to code their systems to allow for an order that sends with an after hours cross flag, as well as a TIF that allows for the ETC order type, and with a price equal to the closing price itself.
So Ed, how is it different from other after hours crosses?
So there have been other attempts by other exchange venues, both in the United States and Europe. Europe in particular has something called, trade at last, or TAL, out there that's been out there for a while. But if I look at the attempts that have been made in the US, I target, a couple things. One, the advertising of interest. If you don't tell people that there's interest, it's kind of like, two ships crossing an ocean in the middle of the night, they're blind. They're like, what are the likelihood of those two, to cross paths? And so what we're doing with the NOII format, as I mentioned, is we're telling people that there's an interest in this security with exact shares, so that they can come in and either post their interest for other people to react to, or people who want to react see information and then react to it. And then the other thing that's unique to this is we're using a limited time period. So there are other after hours crosses attempts that have been done, and maybe they're at 5 o'clock at night, 6 o'clock at night, 8 o'clock at night, where you kind of lose attention. As the day goes on, there could be market news events. You just lose the attention. And if firms want either risk on or risk off, there's often that flurry of activity right after 4 o'clock to square up positions or to add to positions in terms of, that type of thing. And then lastly, what we've done is to alleviate any concerns that, the closing price could become stale. There could be a news event. There could be just market movement after 4 o'clock. We've put very tight collars around the product, where if a particular security was to move in price and the closing price was no longer relevant, or it might be stale because of some news, we'll suspend trading in the ETC. So the firms have the comfort to know that Their orders are not going to be sitting out there at potentially stale prices, and then only have interaction during those periods of time. So what we really want is the confidence that they can trade in this, trade with larger size, and the confidence to know that they're getting kind of a like-minded, neutral counterparty that just wants to trade at the closing price.
Right. So who will be using it, and what is the use case?
So, when I look at the use cases, I certainly see firms that may not have gotten their orders in by 355 for market orders or 358 for limit orders. They may have had a limit order that was too passive in price. So they may want to, increase their participation during that period. I can certainly see algos that have a certain participation rate that they want to do over the course of the day, and they may not have either, again, their limit may be passive, they may have misjudged or undercalculated what the close should be or where their participation should be. And then they themselves can use the ETC. And then lastly, I would say there's a large market for what I would call opportunistic traders that, we have buyers and sellers meet all day long at prices. And those prices during the day, their orders may or may not have price impact. So opportunistic traders that are either looking to, add risk by adding to positions, whether that be adding to an existing position or creating a new position based upon a favorable price, or the opposite is true, someone who may have been left over with a position and is looking to sell, or maybe they didn't sell as much as they wanted in the close, therefore, making it easier for them. And if I look at the after hours, it's typically notable for, being a lot less liquid than the primary market between 9:30 and 4. And so hopefully this will make it easier for traders, at least in some cases, to affect trades in the post-market session.
Right. And finally, Ed, in the last minute here, has there been much interest with ETC?
Well, if I look at, the overall interest, we've been, talking to clients a long time about this. We got a lot of feedback on it. And if I look, I'm at Nasdaq, I guess maybe 9 years now. Probably I've had more conversations with more of a variety of firms, that have all sorts of business models than probably any other product I've been involved with, in terms of a rollout. And then I think of ETC, as a product in which we were trying to, supplement people's ability to trade at the closing price. It's another, I often say, a tool in the toolkit for traders as to if they need to access liquidity post the market, this may become a, kind of a go-to first stop, post 4 o'clock to try and trade. And then the other thing that really sparked me was how much interest there was in this. And it really, in my mind, demonstrates, the need to be innovative around the close, to continue to, evolve as people, trade in the close more and more often, and then lastly, I'll look at, Nasdaq itself probably spends more time, money, and effort in making sure our crosses are innovative, they're robust, and that, as an example of that, we certainly hope that ETC demonstrates the commitment to continue to evolve, kind of what I would call our, world-class leader in automated auctions.
All right, Ed, we appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Always a pleasure to be with you, Jill.